Hello, my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month copper, aluminium and lead.
LME 3-month copper. So it is now 4 weeks after the market created a weekly key reversal down, as well as during that week over Wednesday, Thursday and Friday, a 3-day bearish stick sandwich pattern. 3 weeks ago, we saw the follow-on lower to these two patterns, with prices punching down through the lowest and arguably the weakest of the three recent congestion zones, the one between 91.83 to 91.56. Prices dropped down as far as below the 50% Fibonacci line on July 22 to May 23 move at 90.29, where they seemingly have gotten somewhat stuck. In part, I think it's due to this 50% Fibonacci line, but also include just below the 50% Fibonacci line, the flat but important extension to the upper trend line, highlighted in dark blue of the June to August 2023 ascending triangle, currently at 87.92. This proved itself earlier this year as the support that turned the market higher back in early August. In the slightly bigger picture, the October to date action had created a small bearish descending scallop pattern. This gave a primary target down in the 92.02 zone, which has been achieved, and a secondary hard to reach target X down in the 87.50 zone around the lows of August and just underneath the dark blue neckline. Just in case we do reach there, the next support below that is a small congestion band, 86.65 to 86.86, made up from the 50% Fibonacci line, the October 20 to May 2023 move at 86.86 and the April 2012 high at 86.65. Meanwhile, topside, we have the off-mentioned congestion between 93.95 to 96.06 with the declining medium moving average currently at 93.25. In between this congestion band overhead and the small congestion band 86.65 to 86.86, that is below. We also have the slowly rising long moving average, currently 94.55, still within the 93.95 to 96.06 congestion band. Now, these two moving averages are interesting, as together with the declining short moving average, currently at 90.69, they just about made a bow tie formation 3 weekends ago. I've been very clear in saying this bow tie formation is not perfect. For example, the long moving average is still heading slightly higher and the medium and short moving average are both heading lower. But the moving averages, well, they are in the right order, so I'd pay attention to it. Thus, look at the immediate direction of the moving averages are heading, which is bearish, though not overwhelmingly so, and then look at the count. By this I mean that approximately 15 to 20 sessions after the crossovers, we may see significant volatility. So that would be approximately between the 9th and the 16th of December. So basically most of next week. And it's something to put into your diary, but please be aware this is an imperfect bow tie formation. Finally, this past week has been a lesson in indecision, with 4 out of the 5 days being indecisive patterns of one sort or another, along with their narrowing ranges. This latter point has been key, as it set up the opportunity for this week to try and make a fresh weekly key reversal, which it seems to have grasped with both hands. This being only the second day of this week, we are already set up for a weekly key reversal this week. Thus, if we close this Friday, the 6th of December, either over 89.73 or under 89.71, then we will be on. Anything in between will have the lesser outside week. Right now, we're looking at a weekly key reversal up. Not only that, it would take a minor miracle to close for an outside week in that sort of 89.71 to 89.73 thin band. But I have seen such things happen elsewhere. But we are very much looking at a weekly key reversal up right now. LME 3-month aluminium. The lack of a weekly key reversal here 4 weeks ago after a tumultuous week in many markets, seeing instead here a settling for a lesser outside pattern, fed through to the big move down and big move up 3 weeks ago that sees prices back where they were today, a little bit lower than where we finished 4 weeks ago. We nevertheless initially saw a follow-on lower to the outside week pattern, with prices moving down through some significant levels, all the way down to the support afforded by the slowly rising medium moving average, currently at 25.02, where the decline stopped dead and turned back up 3 weeks ago. This drop lower achieved two things. Firstly, prices reached down to the secondary target that are harder to reach, break below the October to early November bull channel, which was highly satisfactory. Secondly, it set up, as I pointed out 3 weeks ago, it set up conditions for the monthly key reversal down we have seen here in November. We have seen little movement since the end of November, to be honest. The last 3 days of November and all this week so far have seen just lots of indecisive spinning top patterns. Reasonable activity, but going nowhere. So we'll have to look to the larger overall picture, and here we can see prices still being held within a number of patterns, mainly bullish. In the big picture, we have the purple tines of the mid-December 23 to late July this year, bullish Andrews pitchfork. We are currently in between the middle tine above, that's 28.28, and the lower tine below, currently at 24.70. We also have, for the same time period, a bright red, shallowy bullish shift pitchfork. The market today is just above the slowly rising middle tine, currently at 25.78. And we've seen the last 4 days just that indecision poking through again. Finally, sitting closer to home, we have a dark blue late July to early September bullish shift pitchfork, pierced above and below but seemingly still operational. The market is just above the lower tine today, currently at 25.76. Now this lower tine intersects with the bright red middle tine this week, and on the surface this might indicate a doubling of the bullish incentive, but there's also the opportunity for the bears out there to smash two supports with one hit, should they choose to, though they seem to be in no hurry to do so right now. LME 3-month lead. 3 weeks ago I detailed the number of supports below the market at the time, as well as the resultant move that is still all very significant now, and I quote, "Some of the supports below, some of them well below, Fibonacci-based congestion otherwise between 1994 to 2002, followed by the June 23 low at 1976, which looked, how shall I put this, less interesting than the 2024 low at 1917, which I suspect is a function of the nearby 2021 low at 1908. There's also a neckline extension, that's currently at 1932, of the July 23 to February 24 head and shoulders continuation pattern. The reason I mention these supports below is that they contributed in eroding the decline we saw in early to mid-September, enough that it was stopped and turned back upwards." End of quote. Okay, so back in the middle of October, the market, after tramping around, broke lower 6 weeks ago, before recovering a bit up to the green short-medium moving average, currently at 20.57. 3 weeks ago, the market broke even lower, down through, and I quote, "the Fibonacci-based congestion and otherwise between 1994 to 2002, followed by the June 23 low at 1976. End of quote. All the way down to just short of this neckline extension, currently at 1932, of the July 23 to February 24 head and shoulders continuation pattern, where we halted and started to pull back upwards, up over the Fibonacci and otherwise congestion, and last week up over the green short medium moving average, as well as the mauve declining medium moving average, currently at 20.50. As an aside, in the original process of heading lower, the market reached down to the target for the recent bearish halfway hesitation. Well, now, when this was happening, I said 5 weeks ago about such a move lower, and I quote, "That is not all, as if we do get down there and continue, then please be on the watch out for 2 bearish and 1 bullish possibilities. The action from August to date could be then seen as a possible large bearish cat's ears pattern, or even larger early July to date bearish halfway hesitation. Alternatively, could be an opportunity for the mid-July to date triple bottom. This is all getting very interesting now," and that's the end of the quote. So we are today quite possibly moving towards the bullish pattern, the idea of a triple bottom formed between July to date. I said last week, and I quote, "If we start moving higher start moving further higher, up to test the green short medium moving average or the declining mauve medium moving average, then we may well have a triple bottom. End of quote. Today we are trying to stabilize over both the green short medium moving average and the mauve moving average. If this happens, then we should start looking topside at the flatlining gold long moving average, currently at 2114, as well as the nearby congestion area between 2135 to 2138, which contains the 50% Fibonacci line of the March 2020 to March 22 move at 2135, as well as the 50% Fibonacci line of the May to August move for this year at 2138. Establishment of the market over these would be the final stage in completing a potential triple bottom and a trigger for the resultant potential move higher.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.